Hello, I'm Bill Friebel, Executive Vice President with Cornerstone Wealth Management. Thanks for tuning in to our minds versus the markets. Before we get started, let me answer what could be a question you have, which is who is Cornerstone? Because it's entirely possible that you've never heard of us before now. Cornerstone Wealth Management and Cornerstone Wealth Services are registered investment advisors affiliated with LPL Financial. The firm was started in 2005 and has over 110 advisors in 16 states. As independent advisors, many of our affiliates have chosen their own brand, as you can see on the screen. So it's entirely possible that you've never heard of Cornerstone before because you're working with LifeMap Wealth Management, or Ginfinity, or Triada, or any of the others that you see on the screen. All of our advisors affiliate with LPL Financial, which is the largest independent broker-dealer in the country with over 18,000 advisors, $1 trillion in assets, and 0 proprietary products, however, having thousands of investment options for clients to choose from to fulfill their financial needs. So how does this all fit together for you? LPL provides the broker-dealer operations and is a custodian for your accounts. Cornerstone provides support, structure, and scale to our independent advisors as opposed to just being one office and one advisor, which allows your advisor more time to spend with you. This presentation would be an example of that. At Cornerstone, we have an investment team that manages the Cornerstone Wealth portfolios. You may or may not be using this with your financial advisor because, again, this is only one of the options from which they can choose. But the team is headed by Lanny Bao and Karam Naveed. Both are CFAs or Chartered Financial Analysts, which is among the most difficult designations to achieve in the financial services industry. They also hold advanced degrees in finance and economics and are also computer coders. I highlight the coding because it's a tool that aids in their management process. The portfolios they manage have been compliant with the Global Investment Performance Standards for over 10 years, and they manage over 75 different portfolio options designed to meet clients' preferences and risk-return objectives. Lanny and Karam were kind enough to help me put this presentation together. As part of the Cornerstone Wealth portfolios, we believe it's important to have an investment process that is definable and repeatable. This means not flying by the seat of your pants or winging it. Our process is our playbook, and it's evidence-based, it's rooted in fiduciary standards, it's long-term in nature, it's constructed for the client's interest, not a business interest. It's mindful of taking informed risks, ever striving for improvement, but also it's humble. For anyone who is not humble in this business, the market will humble them very quickly. And we think it's very important to always be mindful of that and always keep that as a core tenet of what we do. We believe it's important to have some belief statements to guide our process. What do we believe? We believe that a superior investment management strategy is one that's rooted in steadfast principles, designed for investor behavior, and based on evidence. Why do we believe it? Evidence shows that time and time again, investors, when left to their natural behavioral biases, will make decisions that are often detrimental to their goals. Why does it matter? Well, investors have goals for their money beyond returns: living a comfortable retirement, funding an education, supporting family and causes, and leaving a legacy. Knowing a sound strategy in place to support these goals provides confidence in their financial future. Why do we believe that our approach is better? Well, our principal portfolio construction seeks to address and mitigate the ever-present behavioral traps investors face and keep them on course for the long term. Our portfolios are designed to be tailored to your needs, goals, and most importantly, your level of comfort with risk. Now, you'll see there that I did highlight that our principal portfolio construction seeks to address and mitigate the ever-present behavioral traps investors face and keep them on course for the long term. A lot of that is going to be discussed today in our minds versus the markets. This is something that is, as I said before, a core tenet of our investment process and our strategy. And I think you'll see as we go through the presentation why it is so important to helping you achieve your long-term goals. Our agenda for today is to discuss the economic environment we've been experiencing over the last few months, the market's reaction to the economic environment, and also why your brain might be giving you bad advice. And I said before, we really view this as the problem, those behavioral biases that might be making you think you should do one thing when in reality, maybe doing the other is the better choice. And then also we view that as that's what we're trying to mitigate with the Cornerstone Wealth portfolios. There's no doubt that the last 2 years have been remarkable on many levels. Very few, if any of us, could say they've seen many of the things we've lived through before. We, of course, had a global pandemic, which led to wholesale shutdowns of the economy. Central banks and governments led by the United States pumped in massive stimulus to get through the disruptions. But even as we near what we hope is the endemic phase of this, we still have labor and supply chain shortages. We've also witnessed long-standing global alliances being challenged and shifting in the aftermath. In recent months, we've seen a significant hot war on the continent of Europe with Russia invading Ukraine. In some ways, it has strengthened NATO, but at the same time has ignited hostile rhetoric between the East and West. We've even heard discussions of using thermonuclear weapons in ways not heard since the Cold War. Additionally, new alliances and alignments are forming between nuclear superpowers. While there's fortunately no hot war in Asia, there are geopolitical concerns. North Korea has resumed testing ICBMs and threatens its nuclear capabilities. There are concerns over both new lockdowns in China, as well as China invading Taiwan, much like what Russia did in Ukraine. And we've seen shortages of some US weapons being shipped to Ukraine due to a shortage in so-called rare earth minerals. Some of these are used in guidance systems for missiles. And while rare earths really aren't all that rare, the places on the planet willing to refine them at the final phase of the value chain happen to be in China, and supplies have been getting harder and harder to find. The effects of these events, among others, has ultimately led to the headlines we're seeing on a daily basis. Inflation has been caused by massive amounts of stimulus pumped into the system globally. The supply-demand issues of the oil markets caused by Russian sanctions and the economy reopening, commodity price spikes, rising labor costs, etc. There's an old saying that the cure for high prices is high prices. The thought is that as prices climb, eventually consumers will stop buying or modify their habits. The downside to this is that it also means less economic activity. Central banks are becoming a lot more hawkish. The US Federal Reserve is said to have a dual mandate. And what this means is they both are focusing on full employment in the economy, but also at the same time trying to keep inflation in check. The Fed's comfort zone for inflation is around 2%. And obviously we're well above that right now. So with employment below 4%, there is definitely room to be more aggressive at fighting inflation by raising rates. This could, however, come at the expense of some US jobs as they try to cool the overall economy. The US dollar has been very strong throughout the last 2 years. It's actually been one of the best performing currencies on the planet. While this is good for US consumers buying foreign goods or going on a trip to another country, it effectively exports inflation to the rest of the world and leads to them buying less of our products. And also there are growing concerns over global growth for, quite frankly, all the above. While the Fed has just started raising rates, the market has already started to react to this and has started to anticipate more hikes. Both short and long-term rates have started to move. This has effects on consumers as well as businesses. The higher rates go, the less a car or home you can afford, the less equipment a business can finance. And as demand for credit slows, usually so does the economy. There have been very few places to hide in either stocks or bonds. The more speculative areas of the market have been hit the worst. Some cryptocurrencies, if you've been following that, have actually been cut in half or more. Growth stocks with higher valuations going into the sell-off have fallen the most. Bonds, which usually hold up very well in times of turmoil, are down because interest rates have been rising. Of course, when interest rates rise, bond prices fall. One of the few bright spots in stocks has been the energy sector, as those companies have benefited as oil prices have risen. Times like these are ripe for investors to make impulsive and potentially detrimental decisions. We're going to look at some of the reasons why we do, why we do it, and some ways to hopefully avoid making bad choices. Back in the early 2000s, Dr. Daniel Kahneman and a few other psychologists started working on what is now known as behavioral finance. Today, there have been numerous books on the topics, and degree programs at universities have started across the country. And the focus of the material is really how we make decisions about money, but also how we as humans are hardwired to make decisions in general. The two ways that we make decisions are intuitive, which is about 95% of the time, and reflective, which is only about 5% of the time. When you think about this, it kind of makes sense. In the early days of human beings, our main goal was survival. So if a tiger jumped out of the grass with the hopes of eating us, we couldn't really reflect on the situation. We knew it was bad for us and we had to respond immediately. However, when it comes to investing, many studies have proven that when people are reactive, they are usually making decisions that are detrimental to their long-term goals. And oftentimes, unfortunately, that's the type of decision-making that we use most, both in investing and the rest of our lives. If you don't believe me, just take a look at these results. Here are the actual numbers of the 20-year period ending in 2020 of how the average investor did versus a variety of investment categories. An organization called Dalbar looks at inflows and outflows of mutual funds to determine when investors were buying and what they were buying, and also when they were selling and what they were selling, to determine what the average return would be. Now, there have been some other studies like this that have actually looked at individual account data where it was allowed, and the results were very similar. But as you can see on the screen, and I will highlight this, as you can see on the screen, if you look at what the average investor did relative to the S&P 500 or a 60-40 portfolio of 60% stocks and 40% bonds, or even a 40-60 portfolio, 40% bonds, 60% stocks, the average investor really didn't fare so well. In fact, they barely did better than what the inflation rate was over this period of time, this 20-year period of 2001 through 2020. Now, if you compared that with what inflation rates are today, they've actually been going backward in the sense that they've not been keeping pace with inflation. They've actually lost pace with inflation just because inflation has been so high. While there are more investing mistakes than just the 4 that I have on the screen, these are a few that tie in with Dr. Kahneman's work in behavioral finance. We'll be covering each in a little bit more detail to show you how sometimes our brains can give us bad advice and how to overcome that. We'll be focusing on anchoring, hindsight bias, extrapolation, and also availability and confirmation. We're going to start with anchoring. And anchoring is really just missing the forest for the trees. And it's essentially focusing on one piece of information when making decisions, and then taking that piece of information and maybe overweighting it relative to others. Now, I want to play a little mind experiment with you. I want you to take a look at the 2 diagrams you see on the screen, and I want you to look at the dots in the center of each. Which one is larger? I'll give you a couple of seconds, but I want you to lock in your answer, left or right. If you chose the one on the left, you're wrong. In fact, if you chose the one on the right, you're also wrong. And it's because they're the same size. The point is if you're focusing on just one piece of information, you may not be seeing all things clearly. Now, how does that apply to investing? Well, the way anchoring works is you could maybe focus on a previous high watermark or value in your account. You could focus on maybe only one metric, say like price to earnings ratio, and overweight it too much relative to what's going on in the rest of the market or other metrics that you should be paying attention to. Here's one way to think about this. Here's the same chart of the market performance we saw before, but in this case, we're only focusing on the S&P 500 year to date, and this was actually through, as you can see on the screen, this was May 16th of 2022. And it looks pretty bad. The market at that point was down close to 16%, but that's only when we focus on this time frame. If we pull back and we try to put this in some sort of context over a long period of time, we see a totally different story. And if you look at this, we see a lot of really painful things that happened on the screen. However, investors who stuck with it over the long term were rewarded. I don't want to minimize the pain that you might be feeling in your portfolios right now, but it's needless to say that we've seen things like this before. When you look at how far back this chart goes and some of the really devastating events, we're talking about world wars, we're talking about great recessions, we're talking about really absolutely catastrophic events, global events that took place. In a lot of ways, these things ended up being blips on the screen over long periods of time. We often react to things that have already happened, and that's where hindsight comes in. And everyone always says hindsight is 20/20. However, if you're taking action on what has already happened, you're probably a little too late. Now, what do we hear in investing all the time? We hear past performance does not guarantee future results. However, we almost always look at what an investment has done over the last 1 year, 3 year, 5 year, 20-year time frame and try to somehow judge it as if it's appropriate now. In reality, we don't know what the next 3-year or 5-year or 10-year cycle is going to look like, so it really does not guarantee future results. I always like to use this phrase, spectacularly prepared for yesterday. That's really a kind of a catchy phrase, but at the same time, when you think about it, it really does you no good if you're incredibly prepared for what happened in the past. Now, we see that all the time in investing, and we've seen that over the last few years. For example, a stock is down 50%, and all of a sudden an analyst comes out and decides they're going to downgrade the stock. Well, thanks for nothing. The 50% decline already happened. We also saw this after the 2008 mortgage meltdown, where banks started to increase lending standards after we already started to see defaults. Now, if any of you are students of history, you might be familiar with the Maginot Line. This was actually built after World War I in France, and it was a series of fortifications that were meant to protect the eastern border of France. It was hailed at the time as a work of military genius. Now, had the Germans followed the same plan of attack as they did in World War I, it would have worked perfectly. However, the Germans invaded from the north and went right around the line with faster tanks and faster forces than what the French expected. And the French were essentially guilty of hindsight bias. They were fighting the last war. They weren't fighting the current war. Now, let's take a look at how this applies to investors and how hindsight can oftentimes affect their decisions in terms of when to buy and when to sell. We often hear over and over that you're supposed to do what? You're supposed to buy low and sell high. This chart, however, would tell you that investors do otherwise. The blue line that you see on the screen, that's this one right here, that's the S&P 500. When it's going down like this right here, you could say that this was an opportunity to buy, right? Because it was getting cheaper, so we had the opportunity to buy low. However, if we look at these green bars, the green bars are inflows and outflows of money into stock mutual funds. And what do you see as the market was going down? These green bars go below zero, which meant money was being pulled out of stock mutual funds. So investors were actually selling as the market was going down. Now you see this long period here where the market was going up. And what do you see? People were buying hand over fist, putting more and more money into the markets as the market was going higher. And then again, you see the market going down. And what happened? People started to sell. So investors were actually doing the exact opposite of buy low, sell high. They were selling high. They were selling low in many cases, and they were buying high. I tend to be somewhat of a statistics nerd, and I think it's this way because I like to kind of disprove this concept of extrapolation whenever I get a chance. And extrapolation is basically thinking that whatever is happening today is going to continue on forever. Take the summer of the shark. I don't know if any of you remember this. For me, it was somewhat interesting because again, being a stats nerd, there were some things that were tied to this that I thought were very interesting. But this is the Time magazine cover from the summer of the shark. This is dated May 30th of 2001. Media coverage at the time had you believe that we were experiencing an epidemic of shark attacks in which sharks were actually actively hunting humans. There was a John Stossel 2020 report that said essentially that, where he was interviewing a marine biologist and was asking again, why are the sharks attacking us? There were actually some very tragic stories of some deaths, and there was in fact a 1-month spike in shark attacks. However, by the end of the year, there were actually 9 fewer attacks and 7 fewer deaths than the prior year. By the way, if you do look up in the corner of the slide here, the big question, will Michael come back? Yes, in fact, Michael Jordan did come back and he played for 2 more years, just in case you were wondering. But in investing, we can fall prey to some of the same types of extrapolation. And I want you to look at some of the examples on the screen here. When we do look back, we rarely see economic or market conditions, or life for that matter, staying the same over extended periods of time. I'll give you an example of that. I bought my first house in 1995. I got a mortgage rate of 7.5%. By today's standards, that would be an awful rate. But I recall a coworker at the time telling me, that's a great rate. This, of course, was because we were coming out of a period of very high rates, and we were just at the beginning of rates going down for a much lower period over the next 25 years. If you attempt to extrapolate what's happening today too far into the future, you'll likely be surprised by a different outcome. By the way, the last quote that you see on the screen, "This time it's different," is what famed investor Sir John Templeton said were the 4 most dangerous words in investing. Now, I will tell you that availability and confirmation bias is something that I talk with my kids about all the time. And it's because we live in an environment where we are constantly bombarded with information, whether it's from a TV, social media, print media, etc. Availability and confirmation biases are very real risks for investors. We can find more information very quickly that will agree or confirm our point of view. And not only can we find it, but there's probably an artificial intelligence algorithm pushing it to us. Dr. Kahneman's work suggested that we tend to always go for information that's the most abundant and easy to retrieve. We also tend to stop looking when we find information that agrees with our point of view. In other words, the average investor rarely does deep, intensive, and critical research. Here are just a few examples of maybe some things you've heard just over the last year. I found a commentator on Name the Network who has the same opinion on oil stocks that I do, and she says they're a buy. The Reddit forum says that GameStop is going to the moon. I heard someone on TikTok say they were going to cash because you name the person is in the White House. The problem is that the information we have may not be giving us the entire story. You look at the screen right here, we look at what we actually see in the news, but what really is going on in the rest of the world. However, we put that in our mind as what we now think is the most important thing, but we underweight the rest of the information in many cases, either because it doesn't agree with what we have to or what we think, or we're just not getting that information because we didn't dig hard enough for it. We also tend to wrongly put too much weight in things that agree with our point of view, as opposed to leaving our biases at the door. And this, again, can be what leads to bad decisions. So if we're pre-wired to make more reflective and intuitive decisions, how can we as investors make better decisions? Well, one way is to work with your financial advisor and have a plan in place. Much like a pilot with a flight plan, things are not set in stone. If there is damage to an engine, the plan needs to change. As it applies to your financial plan, ask yourself the following questions. Has your goal changed? Has your risk tolerance changed? Have your immediate cash needs changed? Has your time frame changed? Another best practice is to give yourself some perspective when digesting the information you're receiving, and ask the following questions. Is this normal? Is this part of a long-term cycle? Are you looking at all the data? And has the market maybe already reacted to the data point that you're using? You'll see that I have the image on the screen of the flight that, of course, landed in the Hudson River. This was a situation where there was a catastrophic engine failure. At that point, the flight plan has to change. But in most cases, you don't have catastrophic engine failure. Unless that occurs, we really don't need to change the plan. We need to stick to the plan and make minor adjustments along the way where needed. So let's talk about perspective and how that might be able to help us make better decisions. First, yes, inflation is here. There's no doubt. However, we've had inflation spikes before. Historically, they've been relatively short-lived, with the exception of the 70s and early 80s. But again, there's more to look at than just one data point when it comes to inflation. Demographics, money supply, and central bank posture are just a few. You've seen this chart before, but again, it's very important to keep things in perspective and give some context. While market sell-offs are never fun, they've certainly happened before. Just having that perspective can help, can be very useful and help us stay the course. While the market has gone down many times, at least at this point, it's been temporary. Stocks historically have gone up because companies have earnings that are growing. Until that changes, the odds still seem to pretty much be in your favor. While we've been somewhat spoiled over the last few years with not very many negative years in the market, but when the markets are down, the year-end numbers weren't necessarily that low. And actually, let me do a better job of explaining this chart. If you look at the red numbers that you see on the screen, the red numbers represented the intra-year declines in the market, but then the gray bar itself represented where the market finished the year. So you see we've had some periods where, for example, right here, where in 2020, market was down 34%, but actually finished the year up 16%. Last year, in 2021, we had an intra-year decline of down 5%, but the market finished up 27%. If you look at the 42 years of data that you see on the screen here, actually only 32 of those, 32 of those were positive years, and the average intra-year decline was 14%. So it is very normal to have declines in the market in a given year. We've had that now. Doesn't necessarily mean that we'll finish there. We could finish lower. We could finish up at the end of the year, but it is very normal to see these sell-offs occur. It's just we haven't really had too many in the last few years. Similar to what you just saw, but framed in a different way, over longer periods here, the percentages of time the stock market is up over 1 year, 3 years, 5 years, and 10 years. While there's definitely no guarantee, the odds of having a positive return are in your favor, and increasingly so with longer time frames and longer holding periods. We discussed hindsight just a moment ago. It's easy to go back in time and talk about all the economic conditions that led to why the asset classes you see on the screen either did well or did not do well in each year. And this chart, by the way, is showing you different asset classes and how they performed going back to 2007. However, it's nearly impossible to predict which one will do well next month, next quarter, or next year. You'll also see on the screen the diversified portfolio in the white box, and you'll see this line that connects it all the way through the chart. And while it's no guarantee of a positive return, it has generally never been the best, but also never been the worst. And it's also provided lower volatility along the way than any individual asset class did over this period. Instead of trying to predict what the best performer will be, we suggest periodically rebalancing a portfolio as an alternative to trying to time the market. In a way, it's effectively selling what has done well and buying what hasn't. But as you can see on the slide, it also can help reduce the risk in the portfolio and keep it positioned to capture the upside. So let's look at this a little bit more closely. If you started with a 60-40 mix of stocks to bonds in 1994 and you did no rebalancing until 1999, keep in mind that 1999 was very close to the peak of the tech bubble bursting, not quite the peak, but very close to it. What happened, because stocks did so well over that period of time, you ended up with a portfolio that was 79% stocks and 21% bonds. Well, that was great because you got to experience the returns. However, now your portfolio was riskier than what it was when you started. So it kind of outgrew where you started in terms of your risk tolerance. And chances are you probably got older over that period of time too. So that additional risk may not be appropriate. Now, if you look at what happened then from 2000 through 2002, because you didn't rebalance at that time, you actually had a portfolio that was now less allocated to stocks and more allocated to bonds after that bubble burst. And as a result, you didn't have enough stocks to take advantage of the recovery that took place starting after 2002. So again, rebalancing helps keep your risk profile in line. It also keeps your portfolio positioned for what can come next, while at the same time maintaining that proper risk balance. As I mentioned at the beginning of the presentation, part of our process is to address and mitigate the ever-present behavioral traps investors face and keep them on course for the long term. So here's what we're doing now. What's important to note is this is what we're always doing because we stick to our process. Our process is our flight plan. It doesn't mean we don't make adjustments if necessary, but changes are made within a framework based on principles. So right now we are monitoring information on a daily basis, but being steadfast in our defined and repeatable process. We're managing based on long-term objectives. We are not trying to predict what will happen tomorrow, next month, or next year. When we make adjustments, we look at all information and we do it with perspective. When we look at taking advantage of what we think are mispriced opportunities, we do that based on valuation and not emotion. We rebalance portfolios to balance the overall risk and maintain exposure to capture possible rebounds in prices. But at the same time, we are always sticking to our principles, which are discipline, focus, balance, and consistency, but always remaining humble. We always recognize that there are new things to learn, new information to analyze, new techniques to implement. And if we believe that will be the best thing for our clients and the outcomes in their portfolios, we are always willing to recognize that we can improve. I hope you've enjoyed the presentation today. There obviously is no Q&A because this is a recording. If you do have questions, please reach out to your financial advisor, ask them any questions that you might have, and if they can't answer it, they certainly will reach out to the Cornerstone Wealth Portfolios team and get answers for you. And again, I do want to thank you very much for joining us today. We really appreciate the time that you've spent. We also appreciate you working with your financial advisor who's affiliated with Cornerstone, and have a great day.